Welcome to this week's brief. I often get asked what the biggest challenge is that I'm facing in talking with people, and there are two things that seem to comprise the majority of the discussions recently. First, of course, worries about a stock market crash, which I've covered in many previous briefs. And secondly, people naturally wanting to chase investment returns. Over the last 5 years or so, big companies, specifically large US stocks, have done spectacularly compared to the overall stock market in the US and world. So I inevitably get questions like, should we add to these stocks since they seem to be doing so well? This sounds logical on the surface, but it's actually extremely dangerous. And a little history can go a long way. If you were an investor in the late 90s, you likely recall how well internet stocks were doing. By historical measures, they were quite overpriced by 1997. Still, people said the internet made things different this time, and investors were right for a while, despite warnings about being overpriced. Internet investors chasing returns felt pretty smart until the bubble burst rapidly in 2000. Similar story with real estate in the mid-2000s. People were buying extra properties. Often the statement was heard, well, they're not making any more of it. It's different this time. And again, people were right for a few years until 2007 when there was a huge decline in prices. The lesson here is that people have a genuine fear of missing out, which is about as strong as a fear of losing money. This is why it's very important to be careful when buying something that has extremely high expectations, because it's so easy to miss them. And when something is possibly overpriced to begin with and there's bad news, it tends to be a very sharp loss, just like internet and real estate. Diversification in investments can occasionally seem boring because you don't have all your money in what's ever doing best that year. Owning many things tends to smooth out the ride along the way. And a couple creative strategies with rebalancing can help make a consistently strong rate of return over decades. But it is expected that in every cycle there should be a few hot assets, and inevitably your buddy's friend will brag about how well they're doing. But beware, chasing returns is tempting, but it's often the wrong decision. Thanks for watching this week's brief.